Hi everyone, welcome to Netflix's quarterly report Q3 23, analyzed from a business model perspective. And let's jump in. 9 million subscriber added, beating their own as well as the market forecast. And main contributors were the rollout of paid sharing, as they call it, or as everyone else calls it, the password crackdown, as well as general ongoing expansion of streaming globally. And 10.8% members added year on year, translated into 7.8 revenue growth. So that shows that ARM, or average revenue per member, grew not as fast. And the reasons for that is a higher mix of additions in lower country ARMs, then ongoing unfavorable FX movements, I guess is the right way to say it, and limited price increases, which they started changing from this meeting onwards, and some shift in plan mix, which they haven't further specified, but that will be really interesting to know what that means. Do people go from now a basic or a standard plan to the advertising-based plan? Who knows? That will be interesting to know. One thing that they shared is that 30% of new additions go on the advertising-based plan. Maybe that's kind of what they're saying. In any case, they felt emboldened to give a really good forecast for Q4 as well, of 10.7% year-on-year increase, so very good. The 7.8% year-on-year was on the back of already a pretty strong Q3 22, 5.9% year-on-year increase, so everyone was extremely happy. The share price jumped 15% after the investor meeting or investor update. Now, take into account though, this is where it was at the last Q2 investor update. You may have picked up in our coverage some cautionary notes, but we're not giving any ever investment advice. But yeah, so still about 15% down since then. But certainly a really great update this time around. Now, let's look at engagement metrics. This is, in their words, the best lead indicator for monetization. We have one benefit is from the same source, but downside, it's not seasonally adjusted. So we got data points from May 21, June 23, and now September 23. Netflix stood at 6%, then at 8.2%, and now 7.8%. Let's say its growth trajectory, if you look at the dates. The other thing that's quite interesting here is broadcast. So broadcast 2.5 years ago was at 25%, and then, as everyone thinks, it's the milking cow that we're going to milk. So as expected, it went down quite a lot, but now it rebounded. So it is a bit, not fully. So let's see, the main presumption is that streaming will gain more and more from broadcast. So let's see what happens in that space. That is a pretty fundamental assumption. And this could be just a seasonal rebound. It could be that there were not the fantastic titles on streaming and people just paused their streaming subscriptions for a month or two. That's quite possible. So we'll see. Let's not read too much into it, but the presumption that it's just going to steadily decline, it has to just really be monitored carefully, because it is one of the biggest underlying growth assumptions under all streaming providers. The other one that I find interesting also has been mainly coming from others. So that includes all sorts of different formats also. So very interesting to see what happens there. All right, so business model updates. Here in the business model canvas, all the bold and blue stuff is what has been relevant and said at this time around in this update. And let's jump into it. So business model and engagement. So all the blue italic stuff is their words. We're just highlighting a few key sections. So from a customer relationship and perspective, if you wish to put into the business model canvas, though, we don't have to try to press everything into it, but in any case, one of the most important things to really take into account is that by now it is 70% of their members are outside of the US. And that does require to take into account, as we've pointed out in the last 2 updates on Netflix, take into account really cultural, local perspectives and tastes. And that's that can be very important from a business model perspective and the ability to gain or not gain a competitive advantage in those areas that are designated and hoped for in terms of growth. So here I don't call out these kind of one-off things, but they are just calling out partnerships, etc., that have been a real success, translating certain cultural background, favored content from English into the designated country's language. In this case, Japan, but that's just one example. We could talk about any sort of country, but I think that is a pretty interesting one. Then the other one, we are producing and co-producing in over 50 countries and languages with the goal of delighting local audiences. So very important. Take a look at our previous updates where we said that one of the ways that local streaming providers could work against Netflix's expansion in their countries is to be more locally focused and focus all their financial resources on the local audiences. So that's as small as it may seem. These kind of things that we're talking about here could be interesting from a long-term growth perspective. Then another one is also what we called out a while ago, the sports genre. It is pretty much entertainment and live sports are the biggest genres, then followed by news, etc. And Netflix has decided a long time ago, and they stay with that they're not covering live sports, but they have sports-related programs, which is called sports shoulder programming. So they do have documentaries with, the people up there, Beckham, Neymar, Pele, and whatever. So they are covering these kind of things from a, documentary or shoulder programming perspective, for the lack of better words. And they're pointing out that that's been extremely successful. So very interesting. Then the next one is interesting. So I've cut out a lot of the things, only focusing on the important or interesting things. Licensed titles. So everyone tends to forget that Netflix is still licensing some of the content, and in light of the actor and writer strike, that's been probably a bit of a very good risk mitigator, and they're calling out that that's been very successful. So it's probably also a little bit of a bargaining leverage type thing towards the striking unions. One of them has signed up. So in any case, so very interesting, but keep in mind they are calling out that, this is a program that has run from 2011 and then now very successfully rerun on Netflix. And continuing on, last but not least, just another partnership with an agency on animation. So here, most of you may have already heard about it. They are now investing into real assets, tangible assets, as in what they call the Netflix House. This is a pop-up restaurant, but they're talking about a multi-year investment into the Netflix House. They're framing it as building fandom, and that's probably because, they're probably Reed Hastings is not a huge fan of being unfocused, so they probably have to frame it in a way that it's going to feed the big machine, the big money machine, which is streaming, rather than saying that they're now chasing ancillary revenues, which some internally may see that as the priority rather than feeding the streaming machine. Certainly great news in terms of investors, diversification. It does not always need to be lack of focus. By the way, what we always forget, please like our videos to help us. Then let's continue on to the growth levers. So what they called out, the paid sharing, they still expect that is going to go for a number of further quarters. Cancel reactions continues to be low and ahead of expectations, plus healthy retention. So that was the other one. They're not seeing that fully paying people now swap to shared accounts. They probably also have got some ways of trying to prevent that. And they are going to see what happens over the next few quarters. So their message to investors is they think that there'll be still people signing up to the extra account, and that when you look back to what we had on the first slide, the 10.7% revenue growth, they seem to now have a better understanding how to be able to forecast this. So that's probably where that quite optimistic forecast comes from. Then they have announced pricing increases. Interestingly, I will say, because they were saying that at the last session in Q2, they were saying that that'll follow when the kind of this password crackdown stabilizes and people have switched to the new pricing models, etc. But now they've pulled it forward, as it seems. And not just that, they actually haven't increased all price layers at the same time. So there's quite a bit of customer segmentation going on there. So the ads and standard plan, they have not changed, but increases to the basic and premium plans. What that means is they're trying to upsell the basic plan, because now the gap to a standard plan is smaller, and they already said that the basic plan will be phased out. So they're narrowing the cost differential there, and they will be phasing it out. And the premium has been increased, because almost certainly because they think there's low demand elasticity. So that means people will not jump off. Basically, they're hoping that most of the basic plan guys will go to the standard plan, but I think almost certainly think some may also go to the ads plan. And that may actually be also okay, because the ads plan is a little bit like a platform business model, because they're basically building a supply side of advertisers, of advertising target audience. So that's basically here. All of this slide is around the advertising layer, which is maybe has been more positively received than they initially expected. I do remember the interview with the Bank of Finance specialist Jessica, and the Q2 interview with Ted Sarantos, and they were all very enthusiastic, and Ted was trying to temper the enthusiasm, but there seems to have been built a bit of enthusiasm around that, which is great. So they're probably trying to now build a supply side. Supply side for advertising are always the viewers, because they are the supply side are eyeballs, supply of eyeballs to the demand side, which are the advertisers. That's simply how the business model of advertising works. So look at this. The advertising market, $180 billion globally, excluding China and Russia. Now they have said 30% of all new signups are in that layer. So if they have, a sufficient supply side of eyeballs, so to say, their chances of monetizing on this will be better. So if you want a really a layman's calculation, let's say this is the market share this is the market across all of television advertising, and I don't know if that is, I haven't double checked it, but let's say it is. So multiply with, let's say 10%. We've just seen that Netflix has 8% of viewing there. Let's say 10% for argument's sake. So that's then 18 billion per annum, and then multiply with 30%, because only 30% of that viewing is advertising viewing. So that would be $6 billion per annum. And that's kind of in the ballpark of what they've said last time around, which they said in the long run, they think 10% of their revenue could come from advertising. So very high level, don't use it. It's not investment advice, but just to give anyone a bit of extreme high level methodology, how you could start even thinking about putting this into numbers. So that's kind of, have a look at the bolden part of this, and very interesting as I find. They're also trying to build new ad products, a hero spot, so that they don't have to interrupt the programming. And if you do want to understand Netflix's business model better, this is a product that costs only $3. There's a half an hour walkthrough video in there, or 20 minutes, I think, in this case. But you can learn for $3 a really holistic way of Netflix's business model. And by the way, if you come in time, you get a $10 discount on any future product. So check out our store. This is certainly, this is in earnest, this is our way. We get a lot of emails and requests from lower income countries. This is our way to help any and everyone to get started at a really affordable cost. So continuing on, summary. I've shown the summary every single time for the last 3 quarters. This time I found it to be the most convincing, because the last few times it was always around, yeah, we got the best people and so on. That honestly, that's something that we have heard so many times over so many decades. And not every of those companies has done a good job. Some of them haven't survived even. So this time around, they're showing that their financial strength can really translate to better content. That's what they're trying to say. That's in my mind, a stronger message than they had in the past, where, yeah. So the virtuous cycle is financial strength, and they're saying that it's not that easy to build this, because just take a look how long it has taken them. And they've been kind of the first one to do this. Anyone who follows will have to really, compete with already someone who's very strong and achieve the same from a position of a lot more competition than Netflix had when they entered streaming. So this is certainly a much stronger argument for a defendable competitive advantage than what they had in the previous quarterly updates. Nevertheless, watch all 3 videos, because I think they do build up on each other, on the 3 on Netflix. Watch the other videos that we have, check out our blog, check out our store. Again, summary of everything that we've discussed on this slide. And don't forget, we are not giving you and never will give you investment advice. Check out our disclaimer and terms and conditions if you wish. Thank you.